What can I claim against my capital gains tax, and how can I reduce the tax bill? Hi, I'm Kimberly Shapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. As a property investor, capital gains tax is unfortunately one of those inevitable taxes on the basis that at some point we're likely to sell a property. So the key thing here is, how can we reduce any gains that we've made on a property? So let's have a look today at those allowable expenses of things that you can claim against the property sale that you can help to reduce that capital gains tax gain, which reduces the tax that you'll have to pay. Now, unfortunately with capital gains tax, this is quite limited. So it's very key that we are actually including all of those costs that we can be enabled to claim, rather than leaving anything out. So when we sell a property, we know our sales proceeds of whatever it may be. So let's throw a figure out there of 200,000. Now, it may be we've bought that property for 100,000, so we know we can definitely claim that against the sale of the property. But what else can you actually be claiming? Now, the first thing that we can definitely be claiming is all the legal costs. So if you think the legal cost of purchasing the property, think about the legal costs of selling that property, and make sure that you are including all of the different disbursements and legal fees that are involved in the sale as well as the purchase. Now, typically we use estate agents or some sort of agent to support in selling that property. And again, these are allowable costs. So if you have used an estate agent and there are a couple of thousand that you can be putting in against the sale of the property, again, here is something that we can be using to help reduce that capital gain that we are making. Now, the only other cost that we are allowed to claim is then improvements to the property. So this might be you've put on a new roof, you've put in new kitchens, you've landscaped the garden, whatever it may be, there may be some costs. Now, something worth noting is that if you've actually already claimed those costs as a repair while you are renting that property, you won't be able to claim these costs now because you can't claim them twice. So these are the costs that you did maybe on the property when you refurbished it, or if you lived in it and you rented it, the costs that you incurred when you were doing up that property. Now, one of the crucial things here is that you've got some evidence of it. So whether that's an invoice, whether that is your bank statements, credit card statements showing those costs that you have incurred, you need to have some sort of evidence. So if you've got any properties now that you think in the future you might be looking at selling, make sure if you're spending some money on those properties that you are keeping track of what money you are spending on the property so that you can use it in the future should you need to when you sell it. Now, the reason I say should you need to is because if you are selling your own property, then it doesn't matter. There's something called principal private residence relief, and check out the separate video on what that's all about. But if you are renting out a property and there is going to be some sort of gain on it, then these sorts of improvement costs are quite crucial to try and help reduce and mitigate those capital gains. Some costs that aren't allowable that we just ought to mention today are things like the ongoing costs. So if you've got council tax, if you've got energy costs, you can't claim those against the capital gain. However, if you've been renting the property in that tax year, you will be able to claim those costs against the rental income. So hopefully you'll break even, you might make a smaller profit, or if you do make a slight loss, you can use that loss somewhere else on your personal tax return. But these costs are not allowable for capital gains tax, as it's quite limited what costs you are allowed to claim. When you've pulled together all the costs that you are allowed to claim and you've got some evidence and you hold on to that evidence, should there be any questions from HM Revenue and Customs, then you can do your calculation to find out what your actual gain is. This doesn't mean that that is necessarily going to be the final figure that you pay tax on, as there may be some capital gains tax reliefs that you may be able to make use of, depending what you've done in that transaction. So speak to your accountant or check out some of the videos on the capital gains tax reliefs to see what may be available to you to help reduce that capital gains tax amount. It's very key at this time in our tax lives where the capital gains tax allowances are now reducing, that we're claiming as much of our allowances, as much of our expenses as possible against these gains to help minimise any capital gains tax that is due. If you are someone who owns a property in your own name, but you are married to a spouse, then you can look at transferring that property into your spouse's name before you sell the property. Now you might say, why would I do that? Well, that gives you 2 capital gains tax allowances. So in the tax year for 2023 to 2024, the allowances are £6,000 per individual. So that would double it to 12. And after that, from 2024 onwards, it's going to £3,000. So again, if you are able to transfer it into joint names, then that would mean you go from £3,000 to £6,000. So again, it's just a way of mitigating those capital gains tax liabilities and helping to reduce the tax that you're inevitably going to have to be paying. So just another quick tweak of how can you help to minimise your capital gains tax bills by using the tax rules effectively to make sure that you are doing all in your power legally to minimise these taxes. As you can see from the video today, there is not many expenses we can be claiming against our capital gains. However, there are a few, and the thing I would say is maximise what you can where you can. Check out if there's any reliefs available to help again minimise your tax. And are you able to use more than one capital gains personal allowance? And if possible, then make sure you're speaking to your solicitors ahead of the sale to make sure any actions are put into place before a transfer is enacted. If the transfer has already happened, you can't go back and change things. Whereas if something's not happened yet, you may be able to just do that one adjustment and it may save you several hundred, several thousand in tax, depending what tax you may be paying. Hopefully today you've discovered what you can be setting against your capital gains. If you've got any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing. Let's make tax less taxing.